Dear viewers, sometimes we have to find the cure, and sometimes it's disease that yet to be found. I'm your host Muhammad Asif Jaja, and you are watching my YouTube channel ETV786. We are learning the basic concepts of accounting through this channel, and this is lesson number 19, Cost Accounting. Cost Accounting. Cost accounting is a facet of management accounting that determines the actual cost associated with manufacturing of a product or providing a service by looking at all expenses within the supply chain. It is done for the purpose of budget preparation and profitability analysis. The information derived from this process is useful to managers in determining which product, department, or services are most profitable and which ones need improvement. Cost accounting determines both fixed and variable costs. Fixed costs are expenses that recur regardless of the level of production, such as rent, depreciation, interest on loans, and lease expenses, etc. Variable costs are expenses that fluctuate with changes in production level, such as supplies, material, or labor, and maintenance expenses or factory overheads. Break-even point. Cost accounting determines both fixed and variable costs associated with a product line to determine the break-even point and then ultimately the profit. The break-even point represents the point at which all the expenses, whether fixed or variable, made on the unit of product or services are covered by sale. Profit is determined by using the break-even point, that is the starting point for calculating profit. All sales beyond the break-even point are profit. Determining the number of units that need to be sold to reach the break-even point and then achieve profit is known as cost volume profit analysis. Focus of cost accounting. In the modern days of cutthroat competition, any business organization has to pay attention towards their cost of production. Computation of cost on scientific basis and thereafter cost control and cost reduction has become of paramount importance. Cost accounting primarily deals with collection analysis of relevant of cost data for interpretation and presentation for various problems of management. Cost accounting accounts for the cost of products, services, or an operation. There are four primary methods of cost accounting, each of which allocates indirect cost to individual product lines or services. Classifications of cost accounting. Number 1. Fixed costs. Out of total costs, some costs remain fixed irrespective of changes in the production volume. These costs are called as fixed costs. The feature of these costs is that the total costs remain same, while per unit fixed cost is always variable. Example of these costs are salaries, insurance, rent, etc. Variable costs. These costs are variable in nature. They changes according to the volume of production. Their variability is in the same proportion to the production. Another feature of the variable cost is that per unit variable cost remains same, while the total variable cost will vary. Examples of variable costs are direct material, direct labor, etc. Classifications of cost accounting. Number 3. Semi-variable costs. Certain costs are partly fixed and partly variable. In other words, they contain the features of both types of costs. These costs are neither totally fixed nor totally variable. Maintenance costs, supervisory costs, etc. are examples of semi-variable costs. These costs are also called as step cost. Number 4. Production costs. All costs incurred for production of goods are known as production costs. Number 5. Administrative costs. Costs incurred for administration are known as administrative costs. Example of these costs are office salaries, printing and stationery, office telephone, office rent, office insurance, etc. Classification of cost accounting. Number 6. Selling and distribution costs. All costs incurred for processing an order are called as selling cost, while all costs incurred for execution of orders are distribution costs. Market research expenses, advertising, sales staff salary, sales promotion expenses are some of the examples of selling cost, and transportation expenses incurred on sales, warehouse rent, etc. are examples of distribution costs. Then number 7, research and development costs. In the modern days, research and development has become one of the important functions of a business organization. Expenditure incurred for this function can be classified as research and development costs. Classification of cost accounting. Number 8, predetermined cost. These costs relating to the product are computed in advance of production on the basis of the specification of all the factors affecting cost and cost data. Predetermined costs may be either standard or estimated. Standard cost is a predetermined calculation of how much cost should be under specific working conditions. It is based on technical studies regarding material, labor, and expenses. The main purpose of standard financial accounting, cost accounting, and management accounting cost is to have some kind of benchmark for comparing the actual performance with the standards. On the other hand, estimated costs are predetermined costs based on past performance and adjusted to the anticipated changes. It can be used in any business situation or decision making which does not require accurate cost. Classifications of cost accounting. Number 9, historical costs. These are the costs which are incurred in the past. For example, in the past year, past month, or even in the last week or yesterday. In other words, it becomes a post-mortem analysis of what has happened in the past. Though historical costs have limited importance, still they can be used for estimating the trends of the future. For example, they can be effectively used for predicting the future costs. Number 10, marginal cost. Marginal cost is the change in the aggregate cost due to change in the volume of output by 1 unit. Marginal cost is also termed as variable cost, and hence per unit marginal cost is always same. For example, per unit marginal cost is always fixed. Marginal cost can be effectively used for decision making in various areas. Classifications of cost accounting. Number 11, differential cost. It is also known as incremental cost. This cost is the difference in total cost that will arise from the selection of one alternative to the other. In other words, it is an added cost of a change in the level of activity. This type of analysis is useful for taking various decisions like change in the level of activity, adding or dropping a product, change in product mix, make or buy decisions, accepting an export offer, and so on. Number 12, opportunity cost. It is the value of benefit sacrificed in favor of an alternative course of action. It is the maximum amount that could be obtained at any given point of time if a source was sold or put to the most valuable alternative use that would be practicable. Opportunity cost is measured in terms of revenue which could have been earned by employing that goods or services in some other alternative uses. Classifications of cost accounting. Number 13, relevant cost. The relevant cost is a cost which is relevant in various decisions of management. Decision making involves consideration of several alternative courses of action. In this process, whatever costs are relevant are to be taken into consideration. In other words, costs which are going to be affected matter the most, and these costs are called as relevant costs. Relevant cost is a future cost which is different for different alternatives. It can also be defined as any cost which is affected by the decisions on hand. Thus, in decision making, relevant costs play a vital role. Number 14, replacement cost. This cost is the cost at which existing items of material or fixed assets can be replaced. Thus, this is the cost of replacing existing assets at present or at a future date. Classifications of cost accounting. Number 15, abnormal costs. It is an unexpected cost. This cost arises due to some abnormal situation of production. Abnormal cost arises due to idle time, maybe due to some unexpected heavy breakdown of machinery. They are not taken into consideration while computing cost of production or for decision making. Number 16, controllable costs. In fact, in the competitive environment, cost control and reduction are the key words. Hence, it is essential to identify the controllable and uncontrollable costs. Controllable costs are those which can be controlled or influenced by our conscious management action. For example, costs like telephone, printing stationery, etc. can be controlled, while costs like salaries cannot be controlled, at least in the short run. Classifications of cost accounting. Number 17, shutdown cost. These costs are incurred if the operations are shut down, and they will disappear if the operations are continued. Example of these costs are cost of sheltering the plant and machinery and construction of sheds for storing exposed property. Number 18, capacity cost. These costs incurred by a company for improving production, administration, and selling and distribution. Capacity cost includes the cost of plant, machinery, and building for production, warehouses and vehicles for distribution, and key personnel for administration. These costs are in the nature of long-term cost and are incurred as a result of planning decision. Number 19, urgent costs. These costs are those which must be incurred in order to continue operations of the firm. For example, cost of material and labor must be incurred if production is to take place. Methods of cost accounting. Number 1, standard costing system. Standard costing system assigns an average cost to each direct cost, which is labor, material, and overheads, etc., associated with a product so as to standardize the cost accounting system. This is a popular method of cost accounting used by small and medium-sized businesses. Number 2, activity-based costing. Activity-based costing determines fixed and variable cost in proportion to the direct cost associated with a product line. Number 3, throughput accounting. Throughput accounting focuses on the expansion of an organization's efficiency by reducing production bottleneck and limitations and thereby maximizing throughput. Number 4, cost volume profit, CVP analysis. CVP analysis determines total fixed and variable cost based on the total quantity of product produced. It uses this information to calculate a company's break-even point. Methods of cost accounting. Number 5, job costing. This costing method is used in firms which work on the basis of job work. There are some manufacturing units which undertake job work and are called as job order units. The main feature of these organizations is that they produce according to the requirements and specifications of the consumers. Each job may be different from the other one. Production is only on specific order and there is no pre-demand production. Because of this situation, it is necessary to complete the cost of each job. In this system, a job cost sheet is prepared to compute the cost of the job in a phased manner and finally arrives the total cost of production. Methods of cost accounting. Number 6, batch costing. This method of costing is used in those firms where production is made on continuous basis. Each unit coming out is uniform in all respects and production is made in anticipating of demand. One batch of production consists of the units produced from the time. Machinery is set to the time when it will be shut down for maintenance. For example, if production commences on 1st January 2020 and the machine is shut down for maintenance on 1st April 2020, the number of units produced in this period will be the size of the one batch. The total cost incurred during this period will be divided by the number of units produced and unit cost will be worked out. Firms producing consumer goods like television, air conditioners, washing machines, etc. use batch costing. Methods of cost accounting. Number 7, process costing. Some of the products like sugar, chemical, etc. involve continuous production process and hence process costing method is used to work out the cost of production. The meaning of continuous process is that the input introduced in the process 1 travels through continuous process before finished product is produced. The output of process 1 becomes input of process 2 and the output of process 2 becomes input of the process 3. If there is no additional process, the output of process 3 will be the finished product. In process costing, cost per process is worked out and per unit cost is worked out by dividing the total cost by the number of units. Industries like sugar, edible oil, chemicals are example of the process costing. Methods of cost accounting. Number 8, operating costing. This type of costing method is used in service sector to work out the cost of services offered to the consumers. For example, operating costing method is used in hospitals, power generating units, transportation sector, etc. A cost sheet is prepared to compute the total cost and it is divided by cost unit for working out the per unit cost. Method of cost accounting. Number 9, contract costing. This method of costing is used in construction industry to work out the cost of contract undertaken. For example, cost of construction of bridge, commercial complex, residential complex, highways, etc. is worked out by use of this method of costing. Contract costing is actually similar to the job costing, the only difference being that in contract costing, one construction job may take several months or even years before they are complete, while in job costing, each job may be of a short duration. In contract costing, as each contract may take a long period for completion, the question of computing a profit is to be solved with the help of a well-defined and accepted method. Technique of costing. Costing methods are used for computation of the total cost of production or services offered by a firm. On the other hand, costing techniques help to present the data in a particular format so that decision making becomes easy. Costing techniques also help for controlling and reducing the costs. The following are the techniques of costing. Number 1, marginal costing, and number 2, standard costing. Technique of costing. Number 1, marginal costing. This technique is based on the assumption that the total cost of production can be divided into fixed and variable. Fixed costs remain same irrespective of the changes in the volume of production, while the variable costs vary with the level of production. Variable cost per unit always remains the same. In this technique, only variable costs are taken into account while calculating production cost. Fixed costs are not absorbed in the production unit. They are written off to the costing profit and loss account. This technique is effectively used for decision making in the areas like make or buy decisions, optimizing of product mix, key factor analysis, fixation of selling price, accepting or rejecting an export offer, and several other areas. Technique of costing. Number 2, standard costing. Standard costs are predetermined costs relating to the material, labor, and overheads. The main objective of fixation of standard cost is to have benchmark against which the actual performance can be compared. This means that the actual costs are compared with the standards. The difference is called as variance. If actual costs are more than the standard, the variance is adverse, while if actual costs are less than the standard, the variance is favorable. The variance are analyzed to find out the reasons behind the same. Standard costing thus is an important technique for cost control and reduction. Budget. Budget is defined as a quantitative or monetary statement prepared prior to a defined period of time for the policies during that period for the purpose of achieving a given objective. If we analyze this definition, it will be clear that a budget is a statement which may be either in monetary form or quantitative form or both. For example, a production budget can be prepared in quantitative form showing the target production. It can also be prepared in monetary terms showing the expected cost of production. Some budgets can be prepared only in monetary terms. For example, cash budget showing the estimated receipts and payments in a particular period. Another feature of budget is that it is always prepared for future and that too a defined future. For example, a budget may be prepared for next 12 months or 6 months, but the time period must be certain and not vague. Features of budgetary control. Number 1. It is a continuous process. It involves setting standards and budgets for deciding targets of different expenses and constant comparison of actual the budgeted and standards. Number 2, it involves creation of responsibilities center with clearly defined authorities and responsibilities. Number 3, it also involves timely cost control reports showing the variance between standard and actual performance. Number 4, motivating and encouraging employees to accomplish budgetary goals is one of the essential aspects of cost control. Number 5, actually cost control not only means monetary limits or cost, but it also involves optimum utilization of resources or performing the same job at same cost. Objectives of cost accounting. Number 1, it ascertains the cost of production on per unit basis. For example, cost per kg, cost per meter, etc. Number 2, cost accounting enables to determine the cost of production on a scientific basis, and it helps to fix the selling price. Number 3, cost accounting helps in cost control and cost reduction. Number 4, ascertainment of division-wise, activity-wise, and unit-wise profitability becomes possible through cost accounting. Number 5, cost accounting also helps in locating wastage, inefficiencies, and other loopholes in the production processes. Number 6, cost accounting enables presentation of relevant data in a systematic manner so that decision making becomes possible. And number 7, cost accounting also helps in estimation of cost for the future. Essentials of good costing system. A good costing system should possess the following characteristics. Number 1, it should be suitable to the nature, size, and information needs of the business. Number 2, it should be economical. Number 3, it should be simple to operate and understand. Number 4, it should ensure proper system of accounting for material, labor, and overheads, and there should be proper classification made at the time of recording of the transaction itself. Number 5, before designing a costing system, needs and objectives of the system should be identified. Number 6, the costing system should ensure that the final aim of ascertaining of cost as accurately possible should be achieved. Respected viewers, you are watching the YouTube channel ETV786. This channel is created for business, trade, and commerce students. It includes the playlist that consists of complete lessons on the basic concepts of accounting in stated sequence with multiple options. Right one may be chosen for study or revision. Please try and comment. Please view, like and share the videos and subscribe the channel for watching the updated uploads. Bye bye.